Okay, welcome back. We've got the market, which I think is now taking a bit of a dip, 30 points lower, but nothing major. But there is that pullback, which is emerging in some quarters. Well, let's keep it with earnings for now. And recently listed IKS Health is on a focus now. Now, third quarter revenue growth has been about 17%. And 9-month growth rates look pretty solid. On a quarter-on-quarter basis, of course, they look very muted. Let's understand how to look at these numbers and what the future looks like. Sachin K. Gupta is founder and CEO of the company. Nithya Balasubramaniam is CFO of IKS Health. Thank you both, Sachin and Nithya, for joining us here on the program. Last time we spoke, both of you were in the studios. Not this time. Sachin, how should we look at the numbers? Because revenues, for example, right? On a 9-month basis, I was looking at the investor presentation, 62% growth. On a quarter-on-quarter basis, it's about 2.2% growth. On a year-on-year basis, it's about 16% growth. What will you do for the full year FY25? We'll get to what happened in Q3 and the trends, etc. But just get the basic hygiene stuff out of the way. For the full year 25, what will you end up with on a revenue basis? And then guide us for FY26 as well, given how trends are developing. Go on.
Hi, Prashant. Thank you for having us on the show. So look, I think before I go into specifics, I do want to recap that when we were on our road shows and having our initial conversations, we had laid out very clearly the theme for FY25. And the theme for FY25 was actually a three-pronged theme. One, we were consolidating and integrating a major acquisition that we completed in FY24 that nearly doubled our revenue numbers. And so a big part of this was consolidating that entity and actually in the process of consolidating, pruning and cutting the tail of small customers that they had, because we went from a 50 customer company to an 850 customer company. And when we had acquired Acuity, we were very clear that really it's more like 450 of their 800 odd customers that are going to be the large customers that we're going to be interested in. So one of the themes of FY25 was we were going to cut the tail on the customer base. Second, we were going to get Acuity's margins to the right place by deploying IKS's operating model, our proprietary technology and our global execution into the Acuity customer base, for which we would incentivize their customers through some discounts. And so those two phenomena, those two themes would have a dampening effect on our actual fiscal 25 growth. In spite of that, we had said that we will be actually able to deliver faster than the growth of the industry. The TAM is growing at 12%, the $225 billion TAM, of which 30 billion has been outsourced, is growing at 12%. And in spite of those two dampening phenomena, we've actually delivered a very successful Q3 in 16% growth. And going into Q4, we're actually seeing even more tailwinds, especially as our cross-sell kicks in. And so we expect to deliver even better performance in Q4. In addition, actually, we've surprised ourselves in the glide path of margin improvement, where our blended margins were 24% EBITDA when we acquired Acuity. This fiscal quarter 3, we've actually been able to deliver nearly 31% EBITDA margins. And now I think we've inched much faster, closer to that steady state margin guidance of sort of the mid-30s EBITDA. So all in all, I would say a relatively successful quarter, relative to what we had set as the tone for this fiscal, and looking forward to an even stronger Q4.
Sachin, that's very well put. For 26, give us a sense of what to expect. Will you be in this 15% top line growth for 26? Will you start to ramp up? And margins, you said, is about 30.5 in the quarter and 29.1 for a 9-month period. You said you'll be in mid-30s on EBITDA margin. Revenue and EBITDA margin. Go on.
So on revenue, Prashant, while we're not giving formal guidance, our thought process has always been that the industry TAM is growing at 12%, and we will grow far faster than the industry TAM because we are leaders in the market. So while I will not give a formal guidance on revenue growth for FY26, based on our historical legacy IKS growth rates, which were constantly north of 25% year on year, and the activation of the cross-sell in the Acuity install base, I think it would be suffice to say that we can maintain our thought process of growing much faster than the 12% that the TAM is growing at. And on margins, like I said, we do expect to arrive at the sort of mid-30s margin range in steady state. Whether that happens entirely in FY26 or leaks a little bit into FY27, time will tell. But we certainly intend to continue to be on this improvement path from this 31% towards the mid-30s.
Okay, got that. Nithya, hi. Welcome to the conversation as well. Let's talk a bit more about the client additions because, the client add numbers, I think, so far for the first half are about 778. The mix is obviously largely the US. Can you tell us a little more about the concentration of top 5 clients? I think they've been growing at a pretty good pace of about 19-20%. So do you expect that run rate to continue from the top 5?
Thank you for that Thank you for the question. So if you look at the total number of clients, as Sachin mentioned, we are actually deliberately cutting the tail of the equity customers that we had acquired. If you remember, when we acquired equity, we actually had about 850 plus clients. That this quarter has come down to 750. So this is deliberately done in order for us to be able to focus on the larger clients. If you remember legacy IKS, we always had fewer customers and fewer enterprise scale customers where we would then be able to mine and improve our share of wallet over a period of time. Coming to the second part of your question, we have actually been able to grow our top 10 clients as well as top 5 clients significantly. A large part of our growth is actually driven by our larger clients. And I think going forward as well, given that we actually already have such a large customer base, you will see that most of our growth will be driven by our existing customer base. Almost 90 to 95% of our future growth will actually come from our ability to mine our existing customer base, and the rest of it coming from few new logo additions.
So, just to talk about, since you mentioned equity, I mean, how is that whole sort of piece shaping up for you? And an outlook on the debt as well, because you'd had to, increase your borrowings when that acquisition happened, and gradually that debt level has been coming down. So if you could just guide on that as well.
Sure. I think we continue to be able to generate very, very strong cash quarter on quarter. If you look at our operating cash flows this quarter, north of 150 crores. If you look at free cash flow generation as well, 109.5 crores. So we continue on that path of cash generation, which is why you will see that we have been able to pare down the debt that we acquired when we acquired equity. And therefore, our interest costs have actually come down this quarter. So our net debt position, you would actually note that has actually slid down to, had it been business as usual, has actually slid down to around 510 crores or so. There was an exceptional item this quarter, which again, Sachin had explained on the earnings call. We have advanced about 140 crores to Palomar, which is one of our marquee clients with whom we have done a one-of-a-kind platform deal where we have upfront guaranteed the economic value add. Otherwise, on an ongoing basis, you will find that net debt continues to come down with the cash generation.
Point taken. Sachin, 30-second response to this, maybe a minute. 2 questions. One, there are all these reports that, the Doge team in the US is looking at Medicare and the Social Security programs in a big way to cut spending. Is there any fall through because of that? And second is, is there a risk of some startup in the US? I mean, you're talking about a 35% margin business, but is there, all this AI and new technologies, etc., suddenly disrupting the business, the industry?
So I'll try to give you a quick response to both. Look, I think on the Medicare cuts, our entire business model is built on the foundation of being able to reduce total cost of care and improve quality of care. There are specific features on our platform that actually enable the reduction in total cost of care of managing chronic disease lives. So I think pressures from Medicare and even commercial payers on reducing reimbursement actually are a huge tailwind for our business and will drive even better adoption of our platform. So that I think is a solid tailwind for our business.
Okay. We'll get you on a less busy day, both of you, and it's an interesting business. We're on a earnings treadmill here. Sachin and Nithya, thank you very much for joining us. Good speaking with both of you here. More conversation later. Swiggy